Good afternoon, everyone. Thanks so much for joining us for our November webinar focused on charitable giving. I always love this one because we can learn how we can tie in our philanthropy with also helping ourselves with taxes along the way. And here is our resident expert in this and other subjects. We have Rob Fazekas, our Director of Investment Policy. Thanks so much for joining us today, Rob.
Of course, thank you.
Thanks for being here. I will let you take it away whenever you would like to share your screen.
All right, thanks, Betsy. Good afternoon, everybody. All right, hopefully you can see that now. As Betsy mentioned, we'll be talking about charitable and non-charitable gifting today, as well as some of the changes to the tax rules surrounding gifting, charitable gifting in particular, as a result of the passage of the One Big Beautiful Bill a few months ago. So let me start with just a quick disclaimer, because I will be talking about some general tax strategies on today's presentation. But everybody's tax situation is different. And I'm not a CPA, so this is not considered tax advice. And we strongly encourage people to speak with their tax professional or their advisor before attempting any of these strategies that I'll be talking about today. Okay, so with that out of the way, let's talk about gifting. And, you know, when you really boil it down, there's just two main kinds of gifting. And the first kind is charitable gifting. And these are donations that we can make to a charitable organization, one that's recognized as such by the IRS under Section 501c3. The other kind of gifting really is all other gifting. So these are gifts that you might make to friends or to family members or to a political organization or really any other non-charitable organization. That's non-charitable gifting. Charitable gifting may provide a tax benefit, not always, and not for everybody. And so we'll go through some examples and talk about the situations in which you may get a tax benefit from making a charitable gift. So before we get to that, let's start with non-charitable gifting. So again, these are gifts that are not made to an IRS recognized charitable organization. So these are gifts that you would make to friends and family members or other individuals or other organizations. So this year, 2025, there is an annual gift tax exclusion limit of $19,000 per person. So what that means is that you can give, each individual can give up to $19,000 to any other individual this year, and not have to worry about filing a gift tax return or paying gift taxes or anything like that. In fact, you could stand on a street corner and hand out $19,000 checks to everybody that walks by, and you would not have to worry about gift taxes or gift tax returns. It also means that a married couple can give up to $38,000 to each one of their children this year without having to worry about gift tax returns. Now, it's important to remember that gifts are not considered taxable income to the recipient. But one caveat to that is if you give a gift of an appreciated asset to an individual, and that could be a share of stock that's gone up in value or a piece of real estate, really anything that's a capital asset that's gone up, you should know that the cost basis will transfer over to the recipient of that gift. So what that means is they can accept the gift and they won't owe any tax, immediately. But if they do turn around and sell that asset, they will be responsible for paying the tax on any gain that because of that cost basis transfer. So if you decide that you'd like to give more than $19,000 to an individual this year. That's totally fine too. But the IRS then requires you to file one more form with your tax return. That's Form 709, which is the gift tax return. And really, that's just an accounting form. So that form exists so that the IRS can keep track of your larger lifetime gifts. And they keep track of that because those large gifts made during life will impact your unified gift and estate tax exclusion amount. So everyone gets an exclusion amount where you don't have to pay tax on gifts either during life or after you pass. And the exclusion amount is very large. This year, it's actually almost $14 million per person. And next year, it goes up again to 15 million. So, this is a tax that really does not impact too many people because the exclusion limits are so high. So very few people actually end up paying taxes on, estate taxes or taxes on gifts because of that very, very large exclusion amount. But those Form 709s are going to keep track of the larger gifts that you made during life because that will have the impact of lowering your estate tax limit after you pass. Okay, so now we are going to shift gears to charitable gifting. And probably the first question that pops into most people's mind is, if I give a gift to charity, will I be able to deduct that on my tax return? And the answer really is it depends. It depends on quite a few things, which we will talk about. So going back a few years, if we think back to before the Tax Cuts and Jobs Act of 2017, the standard deduction hurdle was a lot smaller. It was $6,350 per person. But the Tax Cuts and Jobs Act substantially raised that deduction amount. It almost doubled it. And now we've got the One Big Beautiful Bill, which was passed in July. And that new tax legislation actually increased the size of this standard deduction even more. So this year, 2025, the standard deduction is $15,750 per person and $31,500 for those people who are married and file jointly. So this is a very large deduction amount, and it just means that people are less likely than they were in the past to itemize their deductions, right? Because the standard deduction is so high, it's a big hurdle rate that you need to get over before it makes sense to begin itemizing your deductions. And of course, we can't claim a tax benefit for charity unless we are itemizing our deduction. So the first question that you really need to answer is, what is the total amount of all your other deductions that you're going to have this year? So you look at your medical costs, your mortgage interest, your state taxes, your local taxes, all these potential deductions that you could itemize. And then once you have that number, then you also need to know, well, how much are you planning to give to charity? And the combination of those two numbers needs to be greater than the standard deduction. And before you would itemize and get a benefit from that charity. So let's see an example of how that might work. So this is going to be an example of a married couple that files jointly. Let's say this year they have total mortgage interest of $8,000, and their state income tax and their property tax combined is $15,000. Now, as we mentioned before, the standard deduction for a married couple under age 65 this year is $31,500. So now you can ask, well, how much would I need to donate if I want to be able to deduct any portion of my charitable gift? And so you take the standard deduction amount, you subtract all your other potentially itemizable deductions. So that's the 15,000 and the 8,000. That leaves you with $8,500. So this means that your charity needs to be pretty large, over $8,500 this year before you would actually be able to get a tax benefit for any of it. But if it is over 8,500, the amount over that potentially could lower your taxes. Note that in prior years until 2025, the state and local tax limit for the amount that you could deduct was capped at $10,000. One of the impacts of the Big Beautiful Bill Act from July is that SALT cap was dramatically increased from 10,000 to 40,000. So this does help some people, with high state taxes and high property taxes, maybe get over that standard deduction amount and possibly itemize because of that big change in the SALT cap. We'll talk about that a little bit more on a future slide as well. Actually, we'll talk about it on this slide. So one of the changes, as I just mentioned, the enhanced SALT cap deduction from the One Big Beautiful Bill Act that was passed this year. So this is a pretty major impact on the tax rules. So just for the next 4 years, this year through 2028, the state and local tax deduction limit has been raised from $10,000 to $40,000. Note that the enhancement amount, though, is limited based on your adjusted gross income. There's a very steep phase out in that enhancement between an adjusted gross income of $500,000 and $600,000. So if your AGI comes in below $500,000, you can potentially deduct that full $40,000 of state and local tax. If your state and local tax is that high, you're not going to be capped until $40,000. If your adjusted gross income is above $600,000, though, your SALT limit actually goes back to what it was last year, which is just $10,000. So there's a big phase out between $500,000 and $600,000. So basically, every dollar over $500,000 in adjusted gross income, you lose 30 cents of that enhanced SALT deduction limit. But as I mentioned before, because that limit has been enhanced for most taxpayers, they are going to be more likely to itemize their deductions, meaning that means you're more likely to be able to deduct charitable contributions. All right, continuing on with the One Big Beautiful Bill. 3 more changes that impact charitable gifting rules. These changes don't occur until next year, but they may impact some decisions that you might want to make this year because these rules are changing for 2026. So the first one is that starting next year, individuals that do not itemize their deductions will be allowed to deduct up to $1,000 in a cash donation that goes directly to a 501c3 organization. So that would be $2,000 for a married couple. So we haven't seen something like this really since the days of COVID, but this is a new rule starting next year, which is nice for people that just claim the standard deduction because, these smaller cash gifts that you make directly to a charity, you will be able to get a tax benefit for those starting next year. Another change coming next year is they are going to implement a 0.5% floor relative to your adjusted gross income to determine how much of your charity will be deductible. So this means that contributions below 0.5% of your AGI will no longer be deductible. So let's say, I'll give a quick example. If your adjusted gross income next year is $100,000, 0.5% of $100,000 is $500. So what that means is the first $500 of charitable donations will not be tax deductible for you, even if you itemize. Okay. So that's another change to be aware of. And it might, again, impact some decisions that you want to make about giving to charity this year if you think you might be subject to that floor next year. And one last change is that filers in the highest federal income tax bracket, which is the 37% bracket, you will still be able to deduct charitable gifts next year, but only at a 35% rate. So if you give $1,000 to charity this year, you'd be able to deduct the benefit you'd get is $370 reduced from your taxes. Next year it'll be $350. So it's just a slight change there. So what this means, all else equal, is that people that do not itemize their deductions and tend to just give smaller gifts, cash gifts, and tend to take the standard deduction, those donations you might want to save up and give more next year relative to this year, just because you'll get a tax benefit in 2026, whereas you probably won't get one this year. For people that do itemize, your charitable donations are probably worth more this year than they will be next year. And that's because of that AGI floor. So you might want to think about accelerating some of your charity into this year rather than 2026, because you'll get a little bit more of a benefit, based on what your adjusted gross income is. And the same thing, if you're in a very high tax bracket, you might want to accelerate giving into this year compared to next year. It'll be worth a little bit more this year than in 2026. All right, let's talk about some different strategies when it comes to making charitable gifts. So, of course, you can always give cash. Cash is very easy to give. Charities love getting cash because it's easy to spend, and really no hassle to that. There is a deduction limit of 60% of your adjusted gross income as far as how much of a cash gift that you're able to deduct on your tax return. But it's a pretty high limit at 60%. Besides just giving cash, you could also give an appreciated security, whether that's a share of a stock or a mutual fund or something like that. You could consider giving that, and you may be able to get an enhanced benefit by doing so, because you'll avoid realizing the capital gains. So if you give that appreciated security, you still get to deduct the full market value today of that security. But by donating it, you won't have to pay capital gains tax on the gains, and the charity can accept it and sell it. And of course, they're not subject to cash or to taxes, so they get the full value as well of your charitable gift. So that really can be a win-win when you think about giving that kind of security. Another strategy is again for people that tend to not have enough deductions to get over that standard deduction hump. You might consider bunching a few years worth of gifts together into a single year, making one very large gift and then maybe no gifts for the next few years, because that year that you make the larger gift, maybe you do have enough in charity now to get over that standard deduction and itemize and get a benefit on your tax return. Another strategy is to consider giving either cash or securities to a donor-advised fund. And this can often make sense. We'll talk a lot in detail, actually, about donor-advised funds in just a few minutes and how they work. But this can make sense to combine with that bunching strategy, because if you make a very large gift, kind of a multi-year gift into a single year, if you put that gift in a donor-advised fund, you still have control over the timing of when the charities actually receive grants from your donor advised fund. So you can make one big gift to get the tax benefit in a single year, but you still maintain control over the timing of your gifts if you make those gifts using grants from a donor advised fund. And I'll show you an example in a few minutes about how that works. So you'll get the immediate deduction for the full market value of that donation, as long as you're under those AGI limits that we talked about. And finally, there's another strategy called a qualified charitable distribution, which is a QCD. And I will go over an example of how that works as well. If you're eligible, this can be a really powerful tax strategy for making donations. QCDs need to be made from a traditional IRA. They have to go directly to a charity, so not to you first. You have to be a certain age, over age 70 and a half. And there is an annual dollar limit for the size of a QCD, which is $108,000. So digging in a little deeper on the appreciated assets strategy. So again, you have a mutual fund or a stock or something you bought a long time ago that's gone up in value. You could decide to give some or all of that asset to a charity or a donor advised fund, and you'll receive full credit for the market value of that asset when you make that donation. You avoid paying capital gains, and the charity can sell that asset and they'll pay no taxes because they're a charitable organization. If you want, you could even repurchase that asset with the cash that you were going to give to the charity, and now you still own the asset, but your basis is stepped up to the new price that you buy it the second time. So this means that if you do decide to sell it in the future, you'd owe less tax on that asset when you do decide to sell. So that is, again, potentially a win-win for both you and the charity. All right, let's talk a little bit more about donor advised funds. So, there's a lot of different ways to think about this. I like to think about it like kind of a private charitable checking account or investment account that you control and use to make your charitable donations. It's almost like a little mini private foundation, but you don't really have to worry about the paperwork because that's taken care of for you. And they can be kind of fun too. You get to name your own fund after you create it. You can name it after yourself or give it really any name you'd like to. And then you make contributions to that fund on your own schedule. So contributions are considered an irrevocable gift that you make to your own fund. You can contribute cash or stocks or mutual fund shares or really almost any appreciated asset that's liquid and that can be sold. Okay. Now, once the assets or the cash are inside of the donor advised fund, they can be invested, which is nice because then they can actually grow in value over time. And so your charitable dollars can become worth more over time as those investments grow. And then you make grants to the charitable organizations of your choice based on your schedule. So, very similar to just making charitable donations not using a donor advised fund. But it's similar to that, but they just have a different terminology. So they're referred to as grants. But you are in control, and the grants are issued to the charity, and they receive a check that comes from your fund. And the fund is a permanently endowed legacy. So this means, your children, your grandchildren can become involved. So you can, allow multiple generations to be engaged in your philanthropy. There's also no gifting requirement in terms of, a dollar amount or a percentage amount on an annual basis that's imposed by the IRS. Some custodians will suggest a certain amount they would like to see gifted out each year, but there's no legal requirement that the IRS has. Just a little more information on how they work. So again, fully tax deductible when you make a contribution in the year that you make it. You can invest those dollars and they grow tax-free inside the donor advised fund. You can bunch up a multiple years worth of contributions and get a big tax deduction in a single year. And you can also turbocharge this strategy by gifting appreciated assets, directly to your own donor advised fund. Here's a little schematic that kind of shows how that works. So if you are the donor, you can give cash or different assets. We'll start on the left there, to the donor advised fund. They're then invested, and you can see it growing over time. And the donor will receive a tax deduction when they make the donation. They don't receive a tax deduction from the grant. It's when they make the donation to the fund. And then on the right, you can see then the donor chooses to give grants, directly from their donor advised fund to the charities of their choice. So this just sort of is a graphic that shows a little bit how they operate. Okay, so let's continue on with some strategies for gifting to try to maximize a potential tax benefit. So again, we're going to continue on with the bunching strategy here. So if you're someone that tends to take the standard deduction most years, this means that when you give charity, you're not actually receiving a tax benefit for those charitable donations, because the standard deduction is higher than your itemized deductions. But again, if you can group a few years worth of donations together into a single year, whether you use a donor advised fund or not, in that year, you can itemize your deductions. And there's an example here. Maybe you give, you tend to give $10,000 a year to charity, but it's not quite enough to get over that standard deduction amount. So you just claim the standard each year. But instead of 5 years of $10,000 donations, you could give 1 year of 50,000, which would be, well in excess of the standard deduction amount, whether you're an individual or a married couple. And then you'll have the itemized deductions. Your other itemized deductions now give you a benefit as well, your state and local taxes and mortgage interest, anything like that. And so your total deduction could be as high as $60,000, in this example. And that's well above the standard deduction amount. So you'll get a nice tax benefit in that year. This strategy can also work even if you do tend to itemize your deductions, because maybe you itemize, but it's only just a little bit over the standard deduction amount. So you're getting a little bit of a tax benefit, but maybe not a full benefit. So in this case, you could also bundle 3 large years, 5 large years of donations together, and get a large benefit in a single year. And then maybe you cut back on those donations for a few years, and then you get the full benefit of the standard deduction in those years. So if you add that strategy up over several years, you'll end up with a bigger tax benefit than just itemizing and getting just a little bit over the standard deduction. So this really works either way if you're close to that standard deduction amount. Okay, let's move on to our final charitable gifting strategy. And this involves qualified charitable distributions, which I touched on a little bit earlier. And so a qualified charitable distribution, and I'll shorten that to QCD going forward because it's just kind of a mouthful. But a QCD is a transfer of assets directly from a traditional IRA account to a 501c3 charitable organization. Okay, so the transfer needs to go to the charity and not to you first. And if you are age 70 and a half, at least, you and your spouse could each contribute up to $108,000 this year from your IRA to a 501c3 charity. And then the real benefit of this strategy is, done correctly, QCDs are not considered taxable income. Okay. So it's interesting that age, 70 and a half, because it's kind of a strange quirk of the two Secure Acts that we've had in the last few years. We had Secure Act 1 and Secure Act 2 starting in 2019. And both of those acts, Secure Act 1 and 2, raised the beginning age for when required minimum distributions need to come out of your IRA. First, they were raised to 72, and then the last act, Secure Act 2, more recently raised them, depending on when you were born, to either age 73 or age 75. But these two laws did not impact the QCD strategy age. So what this means is you're allowed to use the QCD strategy even before you're subject to RMDs. So you have some extra years there, even before RMDs begin, to use this powerful tax strategy for charitable gifts. Now, once RMDs do begin in your IRA, you can use this strategy to cover a portion or even all of your annual required minimum distribution amount. And again, done properly, QCDs are not considered taxable income, whereas normally an RMD would be fully taxable at your ordinary income rates. Let's look at an example of how much this might be able to save by comparing the QCD strategy to just a standard charitable donation for someone that is subject to an RMD. So this first example, option A, is going to look at not using a QCD strategy, so just kind of a standard gift. So let's take the example of a person who has a $10,000 required minimum distribution that they need to meet this year. So they could withdraw $10,000 from their IRA, early in the year, which will satisfy their RMD. And then at the end of the year, they can make a gift of $10,000 to a charity. And the $10,000 that they took as an RMD will be reported as taxable income. And if they're in the 24% tax bracket, that would be $2,400 of tax that they would owe on that RMD. So that means the total cost of this charitable contribution is actually $12,400 because first it's the $10,000 gift that you made, and then you have to pay tax on the RMD of $2,400, so that's $12,400. Now let's compare that to what this looks like using the QCD strategy. So here, instead of receiving a $10,000 check made out to you from your RMD, you just transfer $10,000 directly to the charity of your choice from your IRA. Now, because $10,000 was distributed from your IRA, that actually is going to satisfy your RMD for the year. So you're done with that. But the good news is that $10,000 is now excluded from your taxable income. So there's no tax bill on that distribution. And the charity still receives $10,000 just like they did in the first example. So, comparing the two, you were able to save $2,400 in tax by using this QCD strategy. So you can see how powerful it can be if you're eligible to use this strategy. There can be, in addition to just the pure tax savings, there's actually some other benefits that you might derive from using a QCD strategy. You'll still get the standard deduction. You're not going to claim the QCD as a charitable contribution. You're not going to itemize that, but you still will get the standard deduction if you don't itemize your other potential deductions. But the QCD, because it's going to exclude that RMD, might lower your modified adjusted gross income for the year. And that's a key figure to focus on because modified adjusted gross income will determine your premiums that you pay for Medicare. So if you can lower that by using this strategy, you may be able to save some money on your Medicare premium because those premiums are determined by your modified adjusted gross income, and the more AGI that you have, the higher your potential cost is on your Medicare premiums. So this can help with that. And just lowering your income can also potentially save taxes on your Social Security. So that's another just kind of side benefit of using this strategy. Okay, we've reached the final slide here. So just to summarize, just some of the things that we went over today. There are some smart ways that you can make charitable contributions that may enhance potential tax benefits. We talked about giving appreciated assets and how that might save on capital gains taxes. We talked about donor advised funds and how you can maybe combine that with a bunching strategy and make a large gift that you get a benefit from in the year that you make it, and then issue grants to your favorite charities in subsequent years. If you're eligible, you might be able to use the QCD strategy and make charitable donations directly from your IRA. And then you can also think about, in your estate planning, what assets it makes sense to give to charity and what assets it makes sense to give to family members. Whereas since the charity is not going to have to pay tax on a tax deferred asset like IRA assets or 401k accounts, it might make more sense to bequeath those to a charity. Whereas taxable assets will receive a step up in basis at death. And so those can be more tax efficient to leave to family members. Well, thanks very much. Happy to take questions if there are any.
Yes, thank you so much, Rob. And if anyone has questions for Rob, you can pop those in the chat box or the Q&A box. We do have two questions around donor advised funds. The first is, how difficult is it to set up a donor advised fund? Is that something we could do before the end of this year?
It shouldn't be too difficult. I would estimate a couple of weeks, maybe. Probably you could actually open an account within a few days, and all the major custodians have these kinds of accounts. So you could open one up at Schwab, you could open one at Fidelity, and it's just an online application. And once it's opened, it'll take a couple days for that, and then you'll have to decide how to transfer assets into it, whether that's cash or securities. So that could take a few more days. But here we are in the middle of November. I think there's still plenty of time to get that done before the end of the year if you're interested.
Okay, great. So if you all want to follow up, we can get you hooked up with your advisor and we'll get that going for you. And then the other is, could you just clarify the donor advised fund, if you are contributing, say, 10,000 a year, but you don't do a distribution or make the charitable gift to the charity until year 3, when are you able to deduct those taxes?
Sure. So the tax deduction is on your contribution to your own fund. And you do not get a tax deduction for issuing grants. So if you were to put $10,000 a year into a donor advised fund this year, next year, and the year after, you'd get a tax benefit. Potentially, you'd be able to deduct those gifts in the next 3 years. Whereas when you issue a grant, that actually has no impact on your taxes.
Very good. Well, thank you so much, Rob. I really appreciate you joining us as always. And what better month to talk about it than the month of Thanksgiving. And we really appreciate you and anyone out there who's watching. We are going to do a roundtable discussion in December, a year-end wrap-up, talking about the major events in 2025 and how they affected the market. And Rob will be on that as well. We always love seeing you and having your insight. So thank you very much, Rob.
Great. Thanks, Betsy.
All right. If you all have any more questions, you can email them to marketing@elevate-wealth.com. and we'll make sure those questions get to Rob. And then this recording will be on our YouTube channel later today. So please feel free to share that with family or friends that you think might be interested. And we will see you all in December. Thanks for joining.